Let's now understand few of the hedge fund strategies, or what are the kind of strategies that varied hedge funds follow as an investment criteria. First group of strategies is classified as event driven strategies. You would find merger and arbitrage hedge funds. Typically these type of hedge funds look for investment opportunities where there is a rumor or high chances of mergers or acquisitions deal possibilities. In this, the hedge fund will buy the shares or long the shares of the target or the acquirer company, possible target, and will short the acquirer. The idea is that in case of such kind of deals, typically the acquirer will end up paying a higher value for the target. As a result, you buy the shares of the target and the value will increase and you benefit from it. And ultimately, when the acquirer pays such a high value for the target, it will ultimately fund it with some debt or some other cash, which will ultimately drain out from the acquiring company and strain the finances and ultimately the profitability of the acquirer. Hence, the hedge fund will short the acquirer shares. Another type is distressed and restructuring. In this case, the idea is that you buy the shares of a company which is nearer to a restructuring deal, and there are improved chances or prospects of the profitability in the near future. So the hedge fund will try and earn an absolute return or a higher alpha return by investing in such stocks. Activist strategy. Here the hedge funds will buy enough amount of shares to account for a significant minority stake, or to the extent of the stake which can influence the major policy decisions of the company. Meaning you will try and have a say in the key important decisions relating to the business and assets of the company. Special situation hedge funds. These hedge funds try to capitalize on the investment opportunities in the securities which are announcing certain kind of special deals, or they are rumored to announce a buyback, or they are rumored to announce a sale of an asset or sale of a significant asset on the books, or sale of a division which is doing very well, which can also lead to a special dividends case of scenario, or demergers or spin-offs of an existing company. The other category of hedge fund strategy is relative value strategies. Here the first one is fixed income convertible arbitrage. The idea here is to exploit the mispricing between the convertible bond and the underlying common stock of the company. So there is a bond of a company which is convertible into common stock. So the hedge fund will buy the convertible bond with its components as well, that is a stock option embedded into that convertible bond, and sell the common stock. The idea is to gain from the fixed income and to make money in case the equity price falls of the company, and gain on the equity shares of the company. Fixed income asset backed. This type of strategy tries to capture the returns from the mispricings across varied asset classes of the asset backed securities, that is either backed by certain financial asset or backed by some mortgage backed securities. Fixed income asset backed. The idea of this kind of a strategy is to capture the mispricings between different asset backed securities or a mortgage backed securities. The other general fixed income strategy is to capture the mispricing or the pricing discrepancies between the different types or different tenors or different maturities or different ratings of fixed income securities. Volatility. This strategy is using options to go long or short on the overall market volatility. The more the volatility, the higher the chances of returns. A multi-strategy can also be kept with an intention of earning a return within or across asset classes or instruments. Meaning they would invest in securities of equity or debt or convertible bonds or currencies, so different asset classes, and there are perceived mispricings and relations between these instruments, and the hedge fund tries to capture these mispricings and earn an additional return. The third type is a macro strategy. Here the hedge fund bets on the global economic trends and events, and could also invest in different asset classes in various geographies. So be it stocks, bonds, commodities, currencies, or interest rates, or etc. The fourth category is the equity hedge strategies. The fourth category is the equity hedge strategies. Within that, market neutral strategy is the one where the hedge fund uses technical or and in combination of fundamental analysis to identify whether there are any under or overvalued equity securities in the market and take the positions in such a way that the overall strategy becomes market neutral or the market risk neutral. That is, the overall market beta comes to or tends towards zero. Fundamental growth strategy, where the idea is to invest in high growth companies. You'll try and buy the shares of companies which are expected to achieve a higher capital appreciation in the stock price as a result of the underlying growth. The other type of the strategy is fundamental value strategy, where you will try and identify if there are any significantly undervalued company stocks available in the market and capture the return. Quantitative directional. Here the hedge funds will use detailed technical analysis and will try and long or short the under or overvalued securities respectively, which are interrelated. So there could be a long on equity and short on bond, or there could be a long on equity of company A in say pharma sector and short on company B of the pharma sector. There would be some relationship between these stocks or the securities, and the hedge fund tries and capture on these kind of mispricings. And the last one, short bias, where the hedge funds believe that the markets are in a downward trend. They'll try and make up the positions in such a way that overall they have a net short exposure in line with the overall market expectations.